Money FM 89.3. Best of breakfast. The bigger picture, only on Money FM 89.3.
Good morning. Welcome to The Bigger Picture. Me, Ryan Huang. And it's a widely risk-off mood in the markets now with the latest news on the trade tariff front. President Donald Trump says he will impose 25% tariffs on all cars that are not made in the United States. And this comes as we brace for April 2nd when these levies plus other reciprocal tariffs against U.S. trade partners kick in. So lots to navigate. And to help us out, we've got Kheng Siang. He is the Asia-Pacific Head of Fixed Income from State Street Global Advisors. Kheng Siang, good morning. How are you doing?
I'm fine. Good morning to you.
Yeah, lots keeping us busy, especially on the trade front. So we've got rising trade tensions. How has that been affecting your view of markets? Has the bad news been fully priced in yet?
I think the news or the development continues to evolve day by day. So it is still too premature to say that we can have a conclusive outcome or scenario at this point. Now, so given the uncertainty surrounding tariffs, we are seeing the market continues to move in a slightly more volatile fashion as news comes out on a piecemeal basis. In the closer to home, in Asia, we have seen the Asian currencies, for instance, weakening as a result of the impacts of tariffs on the exports and so on. At the same time, we are seeing also regulator authorities coming up with some fiscal policy responses from time to time. So I think it is still in a mixed picture at this stage that we are going through some kind of reaction functions from different parties. And so therefore, I think the next few weeks, market may remains uncertain.
Yeah, nervous times with all the uncertainty. Kheng Siang, help us to paint the backdrop of what's been going on with the Asian currency markets, which have been the more sensitive ones and have been taking the brunt of what has been playing out in the markets.
I think for Asian currencies, the ones that so far the last few trading sessions that have been more volatile is Indonesia rupiah. It has got a combination of several factors affecting it. Firstly is the tariffs at the background, hence that has not been supportive. But at the same time, domestically, there are also a number of developments that have been taking place. The new president that came into office recently started to implement fiscal policy expansions on certain areas that he feels should be given more emphasis. At the same time, there's also change in the way how he wants the military's participation in the administration. So there was a revision or amendment to the law that allows the military personnel to be part of the administration. So that created some concern within the people in the country as well as also investors overseas. So there's a concern that the potential kind of martial law situation may at some point in future has that possibility of coming back. So those were that kind of the situation of Indonesia a few decades ago. So at the same time, what the market is looking at is for policy stability and certainty, and here we are getting a bit of noise there. So rupiah has been weakening quite a lot. It is close to the level last seen in the Asian financial crisis in the late 90s. So that's one that has been most affected. The rest of the Asian currencies have been, in general, on average, broadly affected almost the same way against the peers. So no one kind of stands out. I think authorities, of course, is looking at this very closely. Interventions from the central banks have been taking place in a number of currencies. We can expect that they will be on heightened alert given the situations there.
Yeah, talking about central banks, we had the FOMC meeting not too long ago, and we have two more rate cuts on the table, according to the Fed. How does that place the US dollar in the coming year? Because you've got also talk about a weakening US economy. Could that in turn provide some relief for Asian currencies?
Yeah, I think for the Fed itself, because of the uncertainty on the tariffs itself, while we may still expect the Fed to be cutting rates, I think near term the dollar may strengthen given the uncertainty. So that itself will likely mean that Asian currencies will have more headwind in the coming weeks. But at the same time, we should expect that some of the policy measures or countermeasures being rolled out from the Asian authorities would itself help to negate some of the downside risk of growth. So I think that could be potentially some savings grace, but at this moment in time, we may still continue to want to monitor that for further developments.
Yeah, so you have the response from trade partners to look out for as well. Taking a look at where fixed income is heading in the year ahead, how do you play the markets right now with what's been going on and what's to come?
Well, our house view for the fixed income market is that we prefer the rates or the government bond space, because we think that at this point in time, given the growth slowdown backdrop, the central banks are likely to be easing. So that should benefit the rates of the government yield curve with the benefits on the short end part of the curve. So there could be more of a steepening. Versus the other sectors of fixed income, for instance, on credit, we feel that the valuation at this point is not that attractive, given that spreads have tightened quite a fair bit over the last 12 months. So therefore, we have a preference of rates versus credit. And within the credit sector, we prefer slightly more on the higher grade versus the high yield, as there could be still some uncertainty hitting the corporates. And at this stage, potentially the high yield sector may potentially be more vulnerable given the situation there.
Yeah, interestingly, despite the US-China trade tensions, you are quite optimistic with where China is when it comes to fixed income.
Well, that's because for China, given the headwinds to growth and the challenges that they're facing, the near-term growth prospects for China is not that great. So that would be supportive for bond market. Now, we note that the authorities have recently come out with a number of measures and initiatives to try to boost growth. That would help to cushion a further slowdown in growth. But in order for growth to significantly come back up, there are still a number of uncertainties, principally because at this point in time, while the government can continue to drive spending through the public sector, the key lasting sustainable growth would have to come from the private sector. And there we need the business and consumer confidence to be revived. I think that would take some time to come. Hence, overall, we think that the Chinese bonds will remain supportive for the coming months.
Conversely, would Japan be a place you'd be avoiding for now with rate hike expectations?
Yep, it would be that way given the inflation trajectory and the developments in Japan, plus also the communications coming up from the Japanese authorities, including the Bank of Japan. So we would expect that the central bank there will take this opportunity to slowly increase rates, because they have been staying on low rates for a very long time, right? So this is a kind of right window of opportunity for them to take these actions. So that could likely mean that bond yields in Japan going up from here, hence the slightly weaker performance in the Japanese government bond market.
All right, more optimism for the Chinese fixed income market versus Japan. We've been in conversation with Kheng Siang. He is the Asia Pacific Head of Fixed Income for State Street Global Advisors. Kheng Siang, thanks for your time this morning.
Thank you.
All right, great chatting with you. Stay at Money FM 89.3.
Before acting on the information on Money FM, please consider if it's suitable for your own investment objectives, financial situation, and risk tolerance. To listen to more great interviews, download our podcasts at audio.sg or download the audio app. That's AWEDIO, audio at the App Store and Google Play.